you should get a little prompt that will come up and ask you to accept the recording, and we will start today. So I have the pleasure of introducing two panelists that will be with us today. The first, Stephanie Beatty. She's a loan officer for Farm Service Agency, which is USDA, out of New Philadelphia, Ohio. She was born and raised in Newark, Ohio, and met her husband Eric while attending West Virginia University for animal science and agribusiness. They reside in Weirton, West Virginia, and they have a lab named Hank, which we'll have to find out what color Hank is. She's been working for the Farm Service Agency in New Philly as a loan officer for just over 4.5 years. So we welcome Stephanie today. And then our other panelist is Mary Fannin, and she's a financial officer with Farm Credit Mid-America and serves farmers in Columbiana, Mahoning, and Jefferson counties. That's her area of focus. She's been with Farm Credit for 11 years in various roles, multiple counties over the years. I know when we first started working with Mary, she was in other counties than she is now. She graduated from the Ohio University with a Bachelor of Science in Business Administration, majoring in finance and minoring in political science and geography, which is a fantastic combination of things. I think that's so cool. She currently resides in Damascus, Ohio with her husband and 2 children. So we welcome Mary, we welcome Stephanie, and they are going to start us off and talk a little bit about their respective organizations, businesses that they work for. So I think, Stephanie, we will let you go first. So welcome.
Well, I will go ahead and let Mary go first since she has her PowerPoint and all of that, just so everyone can see her PowerPoint, and then if they happen to have any other questions of anything. So I will let Mary go first, and then I will follow up.
Okie doke. Let me get my screen shared on here. Stephanie deferred at kickoff. I like that. Oh. Can you see it? All right. Okay, so thank you so much for the introduction, Emily. That covered some of it. Like she said, my name is Mary. I've been a loan officer with Farm Credit for 12 years now, 11 years, 12 years, somewhere in there. And I've covered counties all over Eastern Ohio, but now I'm settled in my home area, which was a big career goal of mine, wanted to work with the neighbors, and that's been a really big blessing for me to kind of land here, and I hope to stay in this part of the world. So Farm Credit, our purpose is to secure the future of rural communities and agriculture. So our main, we're here to make loans and leases to farmers and rural residents, but we try to go beyond that in supporting the community as a whole. So you'll see us involved in a lot of community events and supporting community events, supporting agriculture as much as we can. And we try to be an advocate for the industry as a whole. We are located, our Farm Credit Mid-America covers Ohio, Indiana, Kentucky, and Tennessee. We're part of the Farm Credit system as a whole. So over 100 years ago, the government recognized that farmers couldn't get credit. Traditional banks were afraid of farming. Farming was tough and they weren't lending money to farmers. So that's where we came in. And we've been doing it for over 100 years now. We have over 100,000 customers. We have over 80 retail branches throughout the 4 states. We have over 1,100 employees, and we have more than $27 billion in money lent out to our customers across those 4 states. So I don't really know how much money that is. It just seems like a lot, right? And our headquarters are in Louisville, Kentucky. We're a cooperative. So what that means is Farm Credit is owned by its customers. So any farmers who come to us for money, they will actually purchase stock in our company, and that gives them, they're an owner and they have voting rights. We have a board of directors made up of our customers who other customers vote for and elect them, and that's who makes the major decisions in how we operate. So we are owned and run exclusively by farmers. One of the big things that we do as a cooperative is we pay patronage. What that means is our customers get a portion of the interest and fees that they pay in every year. They'll get some of that back. The checks will actually go out within the next couple of weeks. And this year we are sending over $200 million back to our customers. So it's their company. And when we make money, we are obligated to give some of it back. Our customers cover all of the commodities in agriculture. About less than a quarter of our portfolio is corn and beans, and 20% is other crops. So wheat, oats, barley, whatever. About 12% cattle. Almost 10% is made up of landlords. So people who aren't actively farming, but they rent their ground out. They are also eligible to borrow from Farm Credit. So we work with timber growers. I have a lot of dairy customers. It's actually kind of surprising to me that our portfolio is only 4% dairy, because personally, mine's a lot of dairy, but I guess when you look across the 4 states, a lot of it's concentrated up here in Northeast Ohio. So what do we lend money for at Farm Credit? Real estate, that's the biggest thing. It's hard to farm without some land. So if you're not renting, you need to buy it. We will make long-term loans on farm real estate. So as kind of a general rule of thumb, we need you to have 25 to 35% down on farmland, but we'll go anywhere from 15 to 25 years on the length of the loan. So that helps spread your payment out. What's really cool about Farm Credit is we offer fixed rate financing on farmland. That's not an everyday thing that you see across all lenders. So if you get a 25-year loan with us, you can get a rate that's never going to change in that 25 years. So it really helps you keep your costs under control when you can lock those rates in and you know what you're working with in the long term. We can finance farm equipment. We can make loans on them or leases. Leases are a kind of an alternative way of financing things, and I could have a whole class on that separately, so I won't go into the details. But when you're working with a lender, loans aren't the only way to obtain financing. Leasing is a really good option, and there are some great tax benefits. So don't ever hesitate to ask your lender, what might you have besides loans? We can finance buildings if you're putting up a barn, a shop, a shed, and on those we can do loans or leases as well. Another big type of lending we have are operating loans. So I'll make this really simple. You need to buy your inputs in the spring and you don't get paid for them until the fall. So you need something to float you along the way. That's what we have an operating loan for. They're a 1-year loan and it's meant to revolve every year. So if you borrow $10,000 for seed and sell $15,000 worth of corn in November, you take 10,000 of that and you pay the loan back as soon as the corn sells, and the money's available again for you in the spring. Now, I know with how we market grain now that it never really looks just like that you sell it all in November and we work through you that way, but it's a really simple way to explain an operating loan, and it's a really important way to cash flow your operation when your cash flow isn't consistent throughout the year. We're passionate about matching terms with your farm. So we're not going to ever finance a tractor over any longer than 5 years. Sure, you might have it longer than that, but you're going to depreciate it pretty quick. And we like to keep the useful life shorter. So we're going to do equipment, cattle, livestock, things like that. I guess I didn't even mention that. We'll finance livestock as well on short terms. And then we're going to keep your real estate and your improvements on a longer term. I'm at Farm Credit. We're always happy to come out to your farm. It is really important for us to know and understand your operation. And sometimes the best way to do that is to see it. So we love to come out to the farms. Please always invite us. We love to see what you're up to. Besides the plain old loan officers like myself, we have an agribusiness division. Those are for our really, really big farmers. We have loan officers who specialize in that, and they have an underwriter who works with them exclusively. So they are out on the farm with them to underwrite those really big loans. We have a crop insurance division. Managing your risk on the farm is so important. And it was important enough to us that we wanted to actually offer the service ourselves. So we have crop insurance agents who are employed by Farm Credit. They are non-commissioned. So whether they sell to you or not, they're paid the same. So their goal is to help you find the product that's best for you. We also have our own appraisers. So it's sometimes hard to get a farm appraisal. Not just anybody can do them. So we have our own staff that helps us with those. We also lend to just rural residents, not just rural residents. We lend to rural residents. If you're looking to buy a home in the country, if you're looking to buy a house on 40 acres, a lot where you want to build a house or even a hunting property, we can lend on that. We have a division called Rural First, and that's what they specialize in. They do a great job. And the big thing I mentioned on farmland, the down payment's usually 25 to 35%. If you're living there, so if there is a house on the property, and there's some other guidelines that if you were interested, we could go into with you. But as a general rule of thumb, if you're going to live there, the down payment's 15%. So that's a lot less scary than if you're just going out and buying farmland. If you're going to live there, the down payment isn't as hefty, and we'll work with you on that. We also have a conversion program. So if rates go down for us, we're going to offer that to you. Say you're at 4% on a 15-year fixed, and it goes down to 3.5%, I'll call you. I'll say, hey, Amber, rates went down. Let's get your rate lower without doing a refinance. So just another benefit of being customer owned. We have a growing forward program. So this is our young and beginning farmer program. It is tailored for our customers who are 35 years of age and younger, or anyone who's been farming for less than 10 years. That to us means you haven't filed a Schedule F for more than 10 years. So Schedule F on your taxes is how we determine that. We have underwriting standards that are relaxed, so it's a little bit easier to get approved. The down payment is lower. So if you are buying that farmland, we can do it with just 15% down rather than that big 25 to 35% down payment. And we offer you the best rate. So you would get the same rate that, Susie, who has been a customer for 37 years, would get. You get the benefit of that. In exchange, we ask that you participate in our Know to Grow program. So it's a 2-day educational conference. It's intense. We really dig in on farm financials, estate planning, production. It's a really great time to talk with whoever you work with in your operation, or just as on an individual level, to spend that time thinking about where you want to go. It's a great program. We also require that you sit down with the loan officer once a year, go over all your financials, and we give you some feedback on that. So we want to grow with you as the operation grows. What should I have ready when I go to meet a lender? Come prepared. Know what you're asking for. Know how much money you need for the project, and know why you want it. So I'd like you to be able to tell us, if I borrow this $10,000 for this tractor, this is how much income I'm going to get from it in return. I love it when a customer comes and sits down and says, this is what I can afford on a monthly payment, so that it shows that you've thought about what you can afford and what you're comfortable with. Know a little bit about your credit history. There are a lot of great resources out there to know your credit score. That's important. It shows us that you've paid your bills on time. Now, there's a big difference between if you're struggling with your credit score because you've been late on things or had some derogatory things going on with your credit, and if you just don't have any credit. So if you've never borrowed money, don't let that stop you from giving us a call. We're happy to kind of work with you on that. We do have some options. Sometimes your credit score is just lower because you haven't had any credit. A balance sheet. So we're going to work with you to put together a balance sheet. That is a list of what you own and what it's worth and what you owe and how much you owe on it. So have an idea of what your balances are and what you owe, and we can work with you on that. And as much income history as you can bring. Tax returns are the best way for us to see that. So 2 to 3 years of tax returns is a good thing. And if you're venturing into something new, have projections. That really helps us know where you think you're going to go income-wise with your project. So I always love to tell people what the characteristics of our top customers are. Those folks are always seeking feedback. They're looking to improve their operation. It's easy to get defensive about where our passions lie, but we're just here to help. Everyone you work with just wants to see you succeed. So don't be afraid to ask your lender for feedback. They're probably more than willing to give it and to help you get where you want to be and reach your goals. Accurate and consistent information that's readily accessible. Have your tax returns, have your balance sheets. The more you know about the cost of production that you're working with, the better. It helps your lender know. And remember that when your lender asks questions, it's because they want to help you get the loan. Our goal is to lend you that money. Sometimes I think people get a little worried that we're asking questions to trick them or to confuse them or to some way find a reason to say no. It's usually the opposite. I'd say 100% of the time it's the opposite. If I'm asking you questions, it's because we're trying to figure out how we can help you. And just have that conversation. Don't be afraid of your lender. I know it can be a really intimidating situation, but don't let it be. Just be there, seek that feedback, and be ready and willing to have that constructive conversation as far as where you want to go financially with your operation. So afterwards, I'll be happy to answer any questions about specific loan programs, but you can always find more online as well. So that is all I have. Stephanie, it's all you.
All right, Emily, is there anything that you were wanting to say before I just go ahead and jump in?
No, you can go right ahead. And then after you're done, I'll ask you each a couple, 2 or 3 questions here.
All right, sounds good. So I do not quite have a PowerPoint, like Mary was very prepared with all of this, but I do have the website, the USD website that I would like to share with you guys. Let's see here. I think Mary has a little bit more experience with this than I do. I'm still learning. All right, so one of the first things, as you can see here, Farm Service Agency is one of the sub-agencies under the USDA. There are numerous different agencies under USDA, and each agency might have different loan programs or financing options. But what I am going to focus on today is specifically the Farm Service Agency loans. I will hit on a little bit of the loans that are available through the farm programs side of Farm Service Agency, but for the most part, what I deal with is the farm loan programs side of Farm Service Agency. So if you are not already familiar with Farm Service Agency, there are offices in most counties within the state of Ohio. If there's not an office in your county, you might just have to go one county over. There are some joint offices. So like, for instance, I'm based out of the New Philadelphia office, but that covers both Tuscarawas and Carroll counties. Now that's just specifically for the farm programs. When it comes to farm loan programs, our territories are a little bit larger. So for instance, even though I'm based out of that office, I do cover about 6 counties. If you're not for sure on which county to contact, then I would say just contact the closest county office to you, let them know what you are interested in doing, and then they would be able to get you to the right office, the right farm loan team that would be able to help you out with all of this. So my specific territory is 6 counties. It is Tuscarawas, Carroll, Harrison, Jefferson, Belmont, and Guernsey counties. And now if you are up a little bit more Mary's way with the Columbiana, Mahoning, those counties, that would be out of our Salem farm loan team, would be up in that region. Typically before everything with the coronavirus, we had everyone coming into the office very frequently, whether they were to come in to participate in farm programs or whether they were to come in to just ask about loans. Our doors were always open and more than happy to help walk-in visitors. Now with COVID-19, our offices are currently closed to the public, but we are doing a lot more through phone, through email, and coming out and doing farm visits. Like Mary said, we love to be able to come out onto the farm about any chance we get. I mean, getting out of the office and all of that is really great. So we love to be able to come out to the farm and talk to you, see your operation, and really understand everything for what you are wanting to do. Also, sometimes it's a little bit easier for you guys as producers to have us come meet you rather than you trying to arrange everything in your schedule for you to be able to come into our office. So one big difference between the Farm Service Agency loans and what we consider to be commercial lending is our loans are considered both supervised credit and temporary financing. We don't compete with the commercial lenders like a Farm Credit. We are here for those individuals when they can't get that financing elsewhere. So whether you're a new and beginning farmer, maybe you don't have as much history, maybe you are an established farmer, but due to some reasons within your operation, maybe you can't get that financing elsewhere at that reasonable rates and terms. So then that's when FSA might be a really good opportunity for you, because then we would be able to more than likely be able to provide longer terms than traditional lending can offer, and also lower interest rates than what that traditional lending can offer. The goal is our rates and terms would be able to help out the operations and be able to get you to that financial point where your future loans you would be able to get through traditional lending, or even ultimately take your loans that you have with FSA and refinance them with that traditional lender. We are able to do financing for both what we call operating loans or what we call our farm ownership loans. Our farm ownership loans can cover purchasing real estate or building on real estate. So say building a barn, building your house on your farm property, any of that goes in under our farm ownership loans. We have operating loans, and we have both what's called an annual operating loan, which is just a one-year loan. So that would be like your annual crop inputs. Now we are different than traditional lending. For us, those loans are just one-year loans. So it's not going to be a revolving each year. You would be able to, have that loan. You would have to apply for a new loan each and every year. We do have term operating loans, and those loans are typically for financing livestock or financing your equipment for your operation. As I said, we typically will have those longer rates or longer terms and lower rates. So here is actually one of our fact sheets that we use when individuals are interested in the FSA loans. This speaks specifically towards, like I said, the farm loan programs. So each of our loans, we have it broken down by the specific type of loan. We have the maximum loan amounts listed here, what the rates and maximum terms on those loans would be, and the use of the loan proceeds, how those loan funds can be used. So as you can see here, just specifically, this is talking about the
Stephanie, I'm going to interrupt you just real quick. I just want to make sure on my screen right now, I'm just seeing a green, like it's a picture of someone talking to a farmer. It looks like, is that what everybody else is seeing too? It looks like you've got another tab open, but I can't see what's on that tab. So I just want to make sure if you're trying to share specific information that we're seeing it.
I'm really glad that you told me this because I thought I was sharing my fact sheet. Give me one moment. And
sometimes if you switch to a different tab, like if you just take your share off and share again, it might come up exactly what you're looking at.
Okay.
That happens to me sometimes. It's okay.
Okay, so share screen. There we go. I think this is going to work now. Can you now see what I'm looking at?
That looks great. Yep.
Okay,
Thank
perfect.
you.
So, like I was saying, this just lists specifically, the farm ownership loans that I was referring to. As you can see, there's different maximum loan limits. And that's because this right here where it is talking about a micro loan, we do have two different applications. And the micro loan application, that is for loans up to $50,000. And again, the micro loan can either be a farm ownership micro loan or it can be an operating micro loan. The nice thing about the microloan program is since it is a smaller maximum loan amount, it's a smaller application for the applicant. And so that's less paperwork for you, and it's actually less documentation for us since it is that smaller loan. So sometimes these microloan applications are really good for a smaller niche type farming operation, or maybe even more that beginning farmer. Maybe they just don't have as much going on as an established farmer. They don't have as much to fill out on our paperwork. So it's a really great program. Established farmers are definitely able to still apply for this microloan program because, again, it's just a smaller loan amount. So maybe they didn't need more than $50,000. So they also still get that same benefit, less paperwork. And I think everyone can agree when you're filling out loan applications, less paperwork is better. So that is why we have that smaller loan application there. When it comes to microloans versus what we just consider our full direct loans, other than the application in itself, some of the eligibility requirements stay the same, some of them differ. When it comes to real estate loans, you still have to meet all of the same eligibility requirements. But when it comes to some of our operating loans, the eligibility requirements are a little bit less if you are looking for an operating microloan versus, say, the direct farm ownership loan for, a larger amount there. Like I said, we would likely have, longer terms. So as you can see, hopefully you can see this right here, the direct farm ownership loans do have a term up to 40 years. And so sometimes operations are needing that longer term in order to make their payment. Maybe a shorter, 25, 30 year that you would get through conventional lending just isn't quite long enough for someone to be able to make that payment. In addition to that, like I said, since we are considered that supervised credit and temporary financing, that goal would be for someone to have a loan with FSA for however many years their operation would need that loan, and then eventually be able to take the remainder of this term and hopefully refinance this debt with a traditional lender later on down the road. Also, another really great program, we have something called the participation loan or the down payment farm ownership loan or farm ownership program. Both of those programs is where you would work with another traditional lender. So you might be working with Mary from Farm Credit. And the participation loans, that's what's considered a 50-50 loan. Sometimes you'll hear it called joint financing, participation, or 50-50 loans. And that's because that traditional lender would finance 50% or more of the loan amount, and FSA would finance 50% or less of that loan amount. In that situation, you would have loans with two different places. You would have a payment that you would be making probably monthly to that traditional lender, and then you would have your annual payment to FSA. Now, with that, each loan would have their own rates and terms. So with FSA, it would be a rate of 2.5%, and it could be a term of up to 40 years. Now, your other loan with the traditional lender would likely have a different rate and different terms. So that's just where you're able to keep track of your two different loans. But sometimes this is an option. If you're not able to get the full loan amount through that traditional lender, then sometimes this 50-50 does work. In that situation, the traditional lender would have a first mortgage and FSA would have a second mortgage on that property. Along the lines with that, we have what's called the Beginning Farmer Down Payment Loan Program, and it is very, very similar to that joint financing. A couple of the biggest differences is FSA would only finance up to 45%, as it says in the second column here. The other lender would finance 50% or more, and the applicant would have to have at least 5% cash down to put, on the loan. The other big difference is those loans have a flat rate with FSA at 1.5% with a maximum term of 20 years. These loans specifically, when I said the Beginning Farmer Down Payment loan is they are specifically for our beginning farmers. So as you can see in this far column over here, it says that it is for the beginning farmers or underserved farmers, which would be considered also our socially disadvantaged. As we continue to go through here, that's where I was also mentioning our operating loans. So like I said, we can finance livestock, we can finance equipment, we can do your annual crop inputs. And again, we have both a micro loan program or the full loan program. Now, I'm also going to attempt to stop sharing again and go back to the screen that I was just at before. So just bear with me for 1 second here. And it is, there's two websites that are very, very helpful for individuals when they are trying to find more information out about FSA's loans. So one would just be the FSA website specifically. And then I believe if I go to this page, you guys should be able to see it. Emily, can you still see this page when I went to farmers.gov? Maybe.
Not yet.
Okay, so I'm going to only talk about one page at a time, and then I will go back to that. So you can see the green screen, correct?
Not yet. We are not seeing anything right now.
You can't see anything. You know, I'm going to try to like do more of these to where I can get better at this because I'm determined to be better one day.
Hey,
Okay.
I think it's showing up now. Yep, there it is.
Perfect. So now if I go to this farmers.gov page, can you also still see it? Great. Okay, so two websites that are very, very helpful will be the FSA website and then also this farmers.gov website. Farmers.gov will include information not only within the farm loan programs, but it is looking at everything under USDA. So you could get information about NRCS programs. You can get information on the farm programs. So there's lots of information here, and you can kind of scroll down here, look at their different tools. For example, they have something called the Farm Loan Discovery Tool. So you answer a variety of questions of how much of a loan you are looking for, what you are looking to use the loan proceeds for, and it will try to point you into the direction of the right loan for you. If you think that you know which loan you are looking for specifically, then that's when you can go ahead and go to this FSA website. So if you just click the programs and services and then go ahead and click your farm loan programs, then that is where you are going to get all the information on the farm loan programs, which is the loans that I do. So with this, it has all of your rates for all of our different types of loans, what our current rates are right now. Our rates are set monthly nationally. So that is something our national office sets that rate. They send it out to us, and those are our rates for that month. Once we approve your loan, you do have a fixed rate for the life of that loan. When you are also looking at individual loans, you can select the certain tabs over on this side. You can also go ahead and scroll down the page. They have something created called your guide to farm loans. Again, that explains all of the different FSA loans that are available to you. If you keep going down through here, I believe if you go ahead and select the option here, then it's going to go ahead and bring up all of our forms that you need to complete an application. Now, all of these forms you should be able to select and type right into, so then you don't have to print it and handwrite it, you know, to start with. Or if you like to handwrite things, you can do that. We can email you applications. We can send an application to you in the mail. We can do all of those things. This is just some information that is available online if someone was interested specifically in this. The last couple things that I would like to say real quick is another real big difference with FSA is for our farm ownership loans. A lot of times we do get calls and people are kind of looking to get a pre-approval letter because they might want to buy a farm, but they're not really sure how much they can afford. So on our end, it's looking and saying, okay, you guys doing a little bit, I guess you could say a little bit of that homework on your end, what you think that you would be comfortable paying each month. But then you actually need to go out and find that farming operation that you are wanting to purchase or that farm real estate that you are wanting to purchase. Because FSA does not do any pre-approval letters or pre-qualifications or anything like that. Whenever you would apply for that loan with FSA, you would actually need to also submit a copy of your purchase agreement or purchase contract that you have with that owner. So that's one of the big differences. One of the most frequent calls I get is when someone is looking to start up their farming operation, kind of where they start. And on our end, it's starting with how much are you wanting to borrow, and do you already have that agreement with the seller? We also are along the same lines of the more information you provide us, the better. So if you go ahead and you have your taxes, you have projections created for how much income you think you're going to be generating off of this farming operation. What do you think your expenses are going to be with the farming operation that you're looking to purchase? Or even if you're keeping your farming operation the same and you're just looking to, say, purchase a new tractor. Are your income and expenses going to be very similar to recent years, or are you adding a new enterprise? Are you going to be changing anything to where you are going to be really adjusting your income and expenses? A lot of what we look at is your projections. So I would say that's kind of a good summary of the farm loan programs here. If you have any specific questions on the different types of loans, or any of that, I would be more than happy to answer any questions.
Thanks, Stephanie. Yeah, I think that's the best place to go right now, since we've all had a chance to hear from both Mary and Stephanie. And I guess I'll throw out there too, obviously, these are not the only two places where you could go for agricultural type loans. There are certainly hometown banks and larger banks that will offer agricultural loans. We don't have any today, but it's not because we're saying don't try those or don't go to those. We just weren't able to get a panelist from a bank to be here today. So just want to throw that part out there. But since you've been able to hear from Mary and Stephanie, what questions do you have? This is your opportunity to ask your questions now. And you're welcome to unmute yourself. You can type it in the chat, whichever you are more comfortable with. And as you're thinking of those questions, I will ask one. Mary mentioned balance sheet. Stephanie, obviously, that's something that you would probably want to know as well. So what are some best practices when it comes to balance sheets? Like how detailed do these need to be? What are you looking at when you want a balance sheet from folks? Mary, maybe we can start with you on this one.
Sure. So ideally, I love to see a year-end balance sheet. So if you can do a 12/31 balance sheet every year, that really helps your lender see how you're progressing over the years. So that's a really big thing. But when you're just starting out, that's probably not where you are. So a current balance sheet, just sitting down and doing it as of that day, I'm going to want to know the balances on all of your accounts. So any checking accounts, any savings accounts. We're going to want to know your inventories. So if you have a livestock operation, even down to weights help us because we price and provide values based on weights. So if you have a breakdown of your heifers by weight or your feeders by weight or age and accurate pricing for those, grain inventories, feed inventories, any supplies you've prepaid. A balance sheet shows us where your money has gone. So if it's not in your checking account because you spent it on, protein supplements for the cows, we want to see that on your balance sheet. So honestly, the more detailed, the better. Now, when you get into really detailed things like tools, you don't need to give us an inventory of all your tools. Just a lump sum value is pretty good. A detailed equipment list is helpful because we match it to your depreciation schedule. So the more detail in that you can provide, the better. But if you're not sure, always ask. Now on the loan side, your credit card balances, your student loan balances, money that you owe to family or friends, that's something we forget a lot. But if you have any personal loans, that is debt, and that's debt that your lender needs to know about. So yeah, lots of detail. The more, the better. And don't be afraid to ask your lender for a blank sheet to use. I bet Stephanie has ones they like. We have ones we like. If you don't have something you're comfortable with, ask your lender.
Great. Stephanie, anything else to add to that?
just agree, more detailed, the better. On our end, we do have a specific form that we use for a balance sheet. If you are able to provide us a balance sheet on your own, or if you're working with another lender and you've already provided them your balance sheet, you can get a printout from them and turn that into us. It just has to be as detailed as what we need. So when it comes to the farming operation, yes, we like to have that as detailed as possible. How many head of cattle do you have out there? How many round bales do you have? How many acres do you have planted? All of that type of stuff. We like to know the specifics. We do also include all of your personal information on our balance sheet as well. But when it comes to some like personal assets, we're not as picky on some of that as what we are when it comes to the farm assets and farm debts. Some personal debts that can really show up funny on credit reports is student loans. So anytime anyone has anything with student loans, we really do like to have you print out a statement from your student loans, whether it's online, whether you get something mailed to you, that can really show us what that balance is, what the interest rates are, all of that, because credit reports are sometimes very great and sometimes your credit report just has something showing up funny. So what we do is we compare what you have listed on your balance sheet for both farm and personal debts, along with another form on our application called our creditor list, where you list basically all of your open accounts, and we compare that with your credit report. So we're looking at all areas just to make sure we're not missing anything, whether it's farm or personal. But yes, as detailed as possible, making sure we know what your open accounts are, making sure we really know what all of your assets are too.
Okay, thank you. We do have a question that came in through chat. What kind of credit score is ideal? And a follow-up to that is medical bills being delinquent held against the person trying to get the loan. And whoever wants to tackle this one first.
So with FSA, we do not look at credit scores. It's a credit, we do pull your credit report, but what we are looking at FSA is what's called your credit history. So one of the eligibility requirements in our handbook is called credit worthiness. So when we're going through the credit worthiness, we are looking and saying, okay, does your credit report show that you've been making your payments on time? When we do public record search, are we seeing any like tax liens, tax judgments against you, anything like that? We're looking at that. Now, when we're also looking at your credit report, as long as the credit report is saying medical, that's one of the big key things with that. It's because that is something that is beyond your control. So it's not something where I would be able to say, we'd be totally good or not good. It would probably just depend specifically on your application, what all is going on and what all is showing up on your credit report, how long it's been showing up on your credit report, and if you've made any movement to try to correct things on your credit report. But we do not look at credit scores in any way.
We're going to differ from that in a little bit, as far as our goal is to see at 720 and above. If it's lower than that because of lack of credit history, we'll consider it. And we're happy to take a look at anything, but 720 is the goal above it. When it comes to medical, so often I pull a credit report and folks didn't even know there was something on there. So similar to FSA, we want to see that you're pursuing it, that you're taking steps to resolve it. The worst thing I can hear is, no, I'm it's wrong, I'm not doing anything about it, because it's just going to eat at your score. And that does play a role into conventional financing when you're working with a traditional bank or someone like Farm Credit. So I would say when it comes to medical, do all you can to get them cleaned up, work with the insurance company, do all that you can. And if you do have an arrangement with them, because a lot of times you're set up on a payment program and it's showing as a collection, let us know that and we'll be as understanding with it as we can.
Okay, thank you. Next question that's come in. Is it true that to qualify for an FSA loan, you have to first have been denied by a conventional loan provider?
So with that, it's a two-part answer. When you submit your application, there's one of those pages where it has a million words and it's just filled with a whole bunch of certifications and you sign down at the bottom. Make sure you're reading that, because when you go through that, it is saying that you do certify that you are unable to obtain financing at reasonable rates and terms through a conventional lender. So also when we are documenting someone's eligibility, there's a whole section in our system that we have to document how they meet each of our eligibility requirements. So with that, whenever I get an application, one of the first things I ask someone is, hey, did you go try to get financing elsewhere? Where'd they go? Where'd you go? What'd they say? So I can make sure that you know you did go somewhere, you did try to get that financing elsewhere. So a verbal confirmation to us is sufficient at the beginning of everything. I always like to caution everyone though is once we get all of your financial information and we put it into our system, if we believe that you can get financing elsewhere, we're looking at everything and we're thinking, wow, like this is really good financially. We think that they're strong enough to get that financing elsewhere. At that point, we can require that you obtain that denial letter for us to continue processing your request. So it's not something we require up front. Everything verbally, like if you're able to call your conventional lender and say, here's what I'm looking at doing, here's my credit score, here's how much money I have, and they are able to say flat out, no, we don't lend on this, or you're not going to meet our requirement here or there, whatever it is, that verbal is perfectly fine with us to start the application.
Thanks, Stephanie. Another question that's come in, how long does the application process typically take? So Mary, do you want to tackle this one first?
Sure. So it depends on what you're asking for. So we actually have a new program for loans under 80,000 that if it's for equipment, livestock, anything that doesn't require a mortgage, so anything outside of land, you can actually apply and be closed within a day. So we can do super fast ones. If you're looking at buying land and there's a mortgage involved, from application to closing, I would plan on about 45 days. So, and of course, there are things that if you need a survey, that's if you're looking to buy land, that's always really important to ask if it needs surveyed. If it needs surveyed, it's going to be a lot longer than 45 days. So, but yeah, on average, I'd say about 45 days to close.
So with FSA, it's a little bit different. I can agree that if you are looking at doing livestock or equipment, those operating loans where we do not have to do anything with real estate, those loans can be closed much quicker than what a real estate transaction would be. Because for us, the real estate loans can be longer. When you are working with the seller or realtor and you're working on getting that purchase agreement, we really recommend that you get that purchase agreement good for 90 days. The reason why we say 90 days is because when we're going through everything, we have to go through it in steps, and we can't jump ahead to the next step until we have this next thing done. One of the big things that actually holds up loans is someone will submit an incomplete application. So on our end, we have to process applications in the order that they're received complete. So if you submit your application, but we're missing certain documents and it takes you 2.5 weeks to get it to us, well, then that's 2.5 weeks your application was sitting there and we weren't working on it. We were working on other applications that were complete. Truly, that's one of the things that really holds up applications. Once we have a complete application, we really do try to have a response to you within 30 days of whether it's approved or not. And then once the loan is approved, as long as there's funding, then that's when we can go ahead and close those operating loans pretty quick. But those real estate loans, once we have to get an appraisal ordered, and I think Mary said earlier, farm appraisals, there's not as many people that do farm appraisals. So it just takes a little bit longer to get somebody out there, get it appraised, and then get that back to us. And once we order the appraisal, it's kind of out of our hands. We're just waiting on them to get it to us. And then same thing with the title work. Once we order the title work, we're just waiting on them to give everything back to us. On our end, though, once we have a complete application, approval or denial, we like to have that to you within 30 days.
Okay, that looks like all the questions that we've had from our participants. So thank you all for submitting those questions. We are about 5 minutes from wrapping up. I just have one last question for each of you. So on my side, I'm actually a family and consumer sciences educator. So the personal finance side is more of what I focus on. I know there's a definite trend, though, when it comes to family living expenses for farms. And just wondering if either or both of you want to talk to that of what you've seen with that trend in recent years and any advice that you have to farm families, I guess, on that cost of or the amount that they're spending on family living expenses.
I can jump in on that. So one of the big things that we see are, and one of the big negatives we see are farms trying to support too many families. Something that I see a lot of families struggle with is the farm's just not big enough to support as many people as they want. So mom and dad are nearing retirement age. You know, you got 2, 3 kids who are married and have kids of their own now trying to live off the same farm. The operations that we see that are most successful, the kids start finding different ways to bring value to the farm. So they diversify a little bit, they bring new ideas to the farm. Maybe someone starts doing some custom harvest. Maybe they look at integrator barns. Maybe they just take the next step for the operation in doing some processing of whatever commodity they have. But the families that are truly successful and want to keep everybody on the farm, they find a way to make it work. But too many families pulling from one operation is a big struggle. Another thing that I see is, so farming goes up and down, right? Commodity prices up and down. When things are good, we see family living go up, but when prices go down, we don't see family living change. So we need to keep our lifestyles to fit that moderate range. That sure, it'd be great to put that remodel on the house because grain prices are high, but you got to make sure you can afford it when grain prices are low. So just kind of finding that comfort level, and not just counting on farming always being good, because unfortunately it's not.
So one thing that I really think about when it comes to that family living, because when we're looking at someone's projections, we look at farm income and farm expenses, obviously, but then we also look at non-farm income and that non-farm expenses too. And for the most part, people are able to say, here's what I think my farm income is going to be. Here's my farm expenses. Here's, if I'm working off the farm, here's copies of my pay stubs. But then when I talk to them about that non-farm expense, a lot of times it's kind of that deer in the headlights look, how do you even go about trying to put a number on that? How do you calculate what that family living expense is? And one of the things that I really recommend to someone when they're trying to come up with that is look at your last couple months pay stubs, credit card bills, all of that type of stuff. If you do work off the farm and that money comes in, where's that money going? One thing, a lot of times people do think that their family living expense is a lot lower than what it really is. We come to that conclusion because we're not seeing the money in a savings account or a checking account or anything like that. So we see money coming in, but we're not seeing savings. So it's having to go somewhere. And that's one of those things. Sometimes hobbies can be very expensive. Maybe someone has a really expensive hobby and it takes a lot of their, non-farm income to that. Maybe it's expensive cars. The prices of cars are really expensive if you're getting new cars, and a lot of people like that. But sometimes that can really affect your family living cost. So it's just really looking at that. I would say if I was trying to find a trend, it's most people have no idea how much they're truly spending, and how much certain things add up. And like even subscriptions, if someone has a monthly subscription to multiple different streaming services or radio or, music or a gym membership, all these things that just automatically come out of your checking. And maybe it only comes out of your checking account once a year, so you forget about it. But all of those things can really, really add up. And I've seen sometimes where maybe the farm is doing okay. Maybe the farm has been able to go through those ups and downs, but maybe, like Mary said, the family living, once it went up, when the farm income went up, it didn't come back down. And it's the family living expenses that's really hurting the operation at that point.
Thank you both. That's something that's like near and dear to my heart as a consumer sciences person. So I appreciate your insights on that. I did put both Stephanie and Mary's emails in the chat. So if you would like to reach out to either one of them with specific questions, please feel free to copy those and put them over into your email. With that, it is 1:01, so we will close today's program. Thank you both, Mary and Stephanie, for being here and sharing all of your insights and all of your information. There's also, I put a couple websites in there. I did not put Farm Credit's website in there. I don't know, Mary, if you want to drop that into chat real quick, you're welcome to do that. But for everyone else, thank you for participating today. We will put this recording up shortly with all of our other webinars. So we encourage you to tune in here in another couple weeks for our next webinar. I will be sending an email to all of the participants probably tomorrow, just to follow up on your experience today, and hope that you all have a fantastic day. Thanks for joining us.
Thanks for having me.
Thanks, Emily.